Okay, so one of the nuggets that we gleaned from our corporate confidence survey is that only 27% of respondents said they're very confident in their current approach to safeguarding cash in a crisis. And one of the reasons we're bringing this up is that it's been a long time since we've had a true financial crisis. I would say 2008 was the last one. There were market stresses during COVID and during the tariff tantrum, for example, but those didn't really approach crisis level. And we think it's important for people to realize that organizations can be negatively impacted, even if they don't have losses, if they simply lose funds availability for a few days. And some of the anecdotes that we'll touch on throughout this webinar are people who had problems because they lost access to their funds, even though they ultimately never actually lost funds.
So, bank deposits are still far and away the kind of the number one place that corporate practitioners park their cash, for obvious reasons, like it's very liquid, easy to get your funds out, same day liquidity, of course. What's interesting is the FDIC insurance being noted as an important factor when most firms are parking well beyond that $250,000 insured limit with their banking counterparties. There have been a couple of, more recent years, there's been a couple of innovations and some fintechs that have been developed to help spread that cash and kind of act as like deposit sweep networks across FDIC, to keep the investment level at just under that FDIC insured level to maintain that safety. But I think we really haven't seen, to your point, there hasn't been a true crisis in quite some time. So I haven't really seen those tested yet. Scott, I think you might have had some direct experience with SVB. So I don't know if you'd like to comment on that.
Yeah, I mean, what was interesting with the Silicon Valley Bank situation is the bank itself was considered a relatively strong, safe bank, but the issue that affected them was their huge concentration in firms that were backed by venture capital and to some extent buyouts that were depositors within their bank. And when the issues with Silicon Valley Bank came up, there was somewhat of a run, and they were not able to deliver all of the cash that was requested. And I, as the chief investment officer at Caltech at that time, with some exposure to venture capital, was very concerned that our portfolio of venture capital companies literally were not going to be able to open for business on Monday morning because they didn't have access to their cash. They weren't going to be able to purchase product or make payroll or whatever it was that they needed their cash for. As it turned out, the government came in and provided liquidity. But it's an example where an institution that you believe is relatively safe all of a sudden can become problematic if there is a run on the institution, which there was in this case. And of course, we also know that it became somewhat it became influenza, if you will, because that then led to runs on a couple of other institutions that people believed were similarly situated in terms of the concentrations.
Yeah, but I'll give you my personal anecdote on that situation. That I joined the State Street and the Fund Connect team the Monday after the FDIC took control of Silicon Valley Bank. So walking in day one and just, everybody was dealing with the fallout, and frankly, the team was doing a great job helping clients open up accounts, to be able to invest cash as they were kind of pulling out from various different banks. So, it was an eye-opening welcome to the cash business for me, if you will. Within I think an important distinction to make is, and we'll get into a bit in terms of the holdings and what these portfolio, what the portfolios are that the funds actually manage. But For Treasury funds, Treasuries and Treasury-backed repos, government funds, same concept, but you can add in government-sponsored entities and government agencies. And then with prime funds, there's commercial paper, CDs, notes, asset-backed securities, other instruments. I think what's important these days too, when we talk about Treasury funds, it's typically split between Treasury-only funds and then Treasury Plus. So Treasury only will not have that repo component. They will only be investing in U.S. Treasuries. The Treasury Plus funds, as you'll hear, will include that repo element as well. And then within government funds, it's really, like I described, Treasury, kind of that Treasury plus the agency exposure there.
Okay, thank you. And is it fair to say in the slide we have here that it goes from the most safe to the least safe as we go from the top to the bottom, or the least risky to the most risky?
That's probably a fair statement, yeah.
Okay. Is there much yield pickup as people go from Treasury to government to prime? Like, is there some compensation?
There's not much of a spread on the Treasury to Govy funds, frankly, particularly with the repo elements in there. The prime funds, you're looking at, maybe at most a 20 basis point pickup.
Sean, briefly describe what is a liquidity fee or what is a redemption gate for people who don't know.
Yeah, sure. So, I mean, the redemption gates, which were revoked, were literally a fund's ability to say, no, sorry, you can't redeem anymore today. That no longer exists. So now this concept of fees is in place. And really that's taking a look at, and there's different calculations, but taking a look at what the outflows are from a fund on a given day. I think, like I said, I think primes, it's 5% they have to look at for that mandatory liquidity fee. But taking a look at the overall outflows versus liquidity of the fund, and it doesn't always necessitate a fee being imposed, but if there is a fee imposed, it's imposed to the shareholders that have placed redemptions, right? So theoretically, it's effectively charging them for taking their money out of the fund. For those investors that stay in the fund, they don't get charged the fee.
Okay.
Well, and the reason they put those in place is in times of crisis, if there's a run on a fund, they may not be able to liquidate their securities at par. And so they may have to sell them at a slight discount, and these fees help reimburse the remaining shareholders for the discount that was incurred as a result of providing liquidity to those who redeemed.
Yeah, and Scott, I think that's an important point. And when I was first talking about the prime funds and then the implementation of the money market fund reform, to your point, by increasing the liquidity requirements daily and weekly, really impacted the prime funds, because given the other instruments it can hold, really impacted their ability to, liquidate when necessary under times of stress. So those two things, again, have kind of led to the decline of primes.
That's always in the literature, but do you know if those are frequently charged, or have there been instances where funds had to charge those fees, or is that kind of a theoretical that they put in?
It's a safeguard. I may have heard of one instance where it was calculated but not actually implemented on a prime fund, but they're safeguards. I don't think they've actually been used.
Okay, great. I appreciate it.
I guess I would just add there, Chris, that with most of these things, the time it will be implemented is exactly when you don't want it to be implemented.
Precisely. Well, and look, that is, and Scott, to your point, that's why the asset managers that have either closed their primes or converted their prime funds was because it's frankly just too operationally complex to manage those mandatory liquidity fees, and it's not worth given the asset size, and it just wasn't worth the effort.
Sean, what do you think clients look at most when you're consulting with them on money funds?
From a safety perspective, size of the fund is kind of most important, and typically size of the fund is correlated with the GSIBs and GSIBs we talked about that operate an asset manager who's running a fund. Not always the case, but there's a pretty high correlation. But size of the fund is pretty important. And then once you kind of narrow down that universe of funds that you're willing to take a look at, it's really the yield.
Well, I was just going to say there's really two levels to the credit or counterparty risk. The first that is people probably think about the most is the credit quality or the safety of the manager of the money market fund. So you may be comfortable with the fund because it's run by a Fidelity or it's run by a JP Morgan. The second level of credit or counterparty risk is what's within the fund. And just because it's a Treasury fund, as we'll talk about in a minute, doesn't mean that there is not exposure to entities other than the US government. Repo is considered generally safe, but it's not the same as holding the actual securities. You are depending on that counterparty, so let's say the French bank, to actually pay you back the cash. And if they do not pay you back, then you have recourse to that collateral, but it's an extra step that you have to go through in order to get the money back. And if there's a bankruptcy in the interim or some other event that disrupts the market or disrupts the liquidity of that particular institution, you may not get your money back immediately. It may take some time. It may have to go through some legal process. And again, that's just another step and something that can disrupt the liquidity of your money market fund.
Yeah, I think what's important to note here, Scott, too, and we've talked about it a few times, and we'll continue to talk about it, but when you think about the safety of the money funds and what the holdings represent, we talked about some of the survey results around folks not really looking into what their money fund is investing in. It's something I encourage practitioners to take a look at so that they know. They know ultimately what they're holding, right? And to your point, whether it's, tying it back to the SVB example, there are plenty of funds that had repo trades on with SVB, right? And some of the other banks that we talked about. And a client, a practitioner who doesn't bank with them might not think they had any exposure, but their fund did. And there are tools available that can help practitioners identify what their actual holdings are. That's really powerful information. Most people don't pay attention to it until it's a time of crisis, and then they want to say, "Oh, what do I actually have exposure to?" Whether that's a banking crisis or a geopolitical event results in some regional disruption. To your point, a lot of foreign banks in these reprograms. So the information's out there. The funds are required to publish their holdings on a monthly basis. Like I said, there's tools available, to help clients identify what those holdings are.
And I can, and just briefly, I can tell you at Caltech, when we were evaluating our Treasury funds, we looked at both who the counterparties were, but even more importantly was the concentration. We wanted to make sure that, no more than, in general, no more than 5% of the fund was exposed to any one institution. And when we found larger concentrations, frankly, we would either reduce our exposure to that fund or maybe even redeem entirely to that fund until we got more comfortable with the various exposures within that fund. Considered one of the safest securities that is available within the world, and they are extremely liquid. So I happened to look up just this morning how much in T-bills were traded just yesterday. And yesterday there were approximately 68,000 trades in T-bills for a nominal value of nearly $200 billion. So it's if you need to liquidate your T-bill within a matter of seconds, it generally can be done pretty easily. The other nice thing about T-bills, at least in this current environment, is that they're generating a nice rate of return. Current yield is for a 4-week T-bill is about 4.25%. Now, that's not to say that it's always at that level. If you go back a few years ago when we were in a much lower rate environment, you would see T-bills as low as 25 basis points or 50 basis points. But right now they're particularly attractive. The other thing to consider is, as you know, with bonds, the farther out you go in maturity, the more interest rate sensitive they are. So a 4-week maturity has virtually no interest rate risk. You see very little variation, even if interest rates were to move. Because the duration is so low, you would not see very much movement in the price. As you go out further, for example, to 1 year, you might see a little bit more movement in the price if there was an extreme movement in interest rates while you owned that security. And I guess the last thing I'd note is that even during April of this year, when there was a big sell-off of the long-term treasuries as a result of the views of how tariffs might impact the economy, there was virtually no impact on the short-term treasury. So you definitely saw movement on the long end of the curve, but on the short end of the curve, it was really de minimis.
The current setup. As Scott explained in detail, T-bills are one of the most liquid financial instruments that there are. They trade many, many billions of dollars per day, and the government is always issuing them because the government has to fund its debt. And historically, T-bills have been perceived as complex to trade and manage, and that's one of the things that Jiko has focused on, is making them easier and eliminating that complexity and making direct ownership of T-bills simple. But based on our survey, historically, people haven't invested in them because they're perceived as complicated products. They're securities. People believe that you have to trade them. Trading is complicated. You have to reinvest the proceeds on maturity, et cetera.
But I think really what it boils down to is there's a lot of information, a lot of data out there to help make better investment decisions, and for folks to be more comfortable about where their cash is and how safe their investments are. Based on your survey results, we saw very few, relatively speaking, are very confident in terms of their cash security today. And we've discussed a number of ways that they can hopefully feel more confident in what they're doing. We always assume cash is cash and is always liquid, but cash and cash equivalents doesn't equal cash under the mattress at home, right? So being aware of where that cash is, what it actually is holding, and how liquid it is really does matter. And again, there's ways for folks to see what it entails. And then, just making sure that you're reviewing your counterparties. Like I mentioned, their bank balance sheets. It's an important thing people typically don't look at, particularly if you're looking at a non-GSIB. And then, as Scott pointed out, who the funds are doing business with, what exposure might you have, as there's some brewing crisis out there. So I think those are kind of three important things that, like I said, there's information and tools available to help investors make smarter and safer decisions.